liquid staking can be as relevant for, let's say, DeFi, that then fixed income can be relevant for traditional finance.
Welcome to the show, Filipe. Filipe is the Chief of DeFi for Ankr, and he's joining us on the show today to share some of the cool things that they are working on.
Hi, Patrick. Thank you for welcoming me in the show.
Thanks for being here, Filipe. Why don't you share viewers a bit about yourself, your background, how you came to be involved in crypto, and how you came to work at Ankr?
Yeah, sure. So my background is more traditional finance. So I worked 8 years as a wealth manager, mostly in Switzerland. And I started to invest in crypto in 2017, like many people. And then I went through this bear market. So I've been educating myself about that space during that time. And yeah, last year, or actually about 1.5 years ago, I started to really dig deeper into DeFi, and I really stopped kind of into liquid staking, really got fascinated by that. And for me, I saw it as something similar to the fixed income market, and it could be potentially as important for DeFi that it is for traditional finance. And yeah, I mean, I started to participate in a few protocols that were integrating liquid staking, and yeah, tweeted about ideas about how that ecosystem could evolve. And yeah, Ankr basically noticed me through my Twitter account, and they proposed me to yeah, hire me on Ankr. Actually, 2 days I left my job in TradFi, and yeah, because I just wanted to really focus on DeFi, and I was learning so much, even just by myself. So it was actually a nice coincidence that it just matched the moment when I kind of decided to leave. Yeah.
Wow. So I did not know that. So you were producing content on Twitter and wherever on your own about liquid staking, and then just happened to come into contact with the Ankr people that way?
Yeah, exactly.
Okay, interesting. And for people who might not be familiar, can you share a bit about what Ankr is doing with liquid staking?
Yeah, sure. So actually, Ankr created liquid staking in December 2020. So we were the first protocol to go to market. So that was in, yeah, December 2020. Lido, I think, came about 2 weeks later. And yeah, I joined Ankr about 6 months after. So, and my task, it was basically to expand that ecosystem so I think it's important to understand that initially liquid staking, it was created to provide liquidity for staked ETH, because you cannot unstake ETH until the merge, right? So that was the main functionality of liquid staking. It was really to like incentivize people to stake, right, ETH, and to contribute for like the transition into proof of stake, and give them the possibility that, you know, there will be some secondary market where they can sell their liquid staking token. And as we expanded to other chains, the narrative shifted a little bit, where it's not all about liquidity only, but it's about kind of solving the capital inefficiency of proof of stake, and to enable DeFi composability on top of liquid staking. So on top of Matic liquid staking, BNB liquid staking, and so on and so forth. And here it becomes very interesting because to achieve price stability, it's not like with, you know, ETH or ETH liquid staking, where you need to have very big liquidity pools to make sure that the price is going to be close to the peg. But when you have liquid staking that is a redeemable token, like in the case of basically all chains except Ethereum, well, then liquid staking has an elastic supply. So whenever there is a discount, you can just unstake, wait a few days, and you lock in the premium. So that provides that alternative price stability mechanism that makes it much less dependent on liquidity pools, and it makes it also more capital efficient. So yeah, that's what we've been, you know, working on with BNB, Matic, Avalanche, and Phantom mostly. On top of, we already have obviously Ethereum liquid staking as well.
Great. And am I seeing correctly that you are adding Polkadot and Kusama soon?
We also have Polkadot and Kusama. So Polkadot, to be honest, we were planning to maybe bring that into a parachain. We were very early on, and unfortunately on Ethereum, there isn't much demand for like Polkadot. So we're considering eventually shifting that into maybe BNB, for example, BNB chain. And we actually have that flexibility because we created our own bridge. So we can now offer like a multi-chain liquid staking experience. And currently you can actually have Matic liquid staking tokens on Ethereum, Polygon, and BNB chain. So we can basically bring those liquid staking tokens with their staking rewards from their native chain into other chains, and to enable DeFi composability in other chains than the native one.
Interesting. So you guys built a bridge to,
Just
like you
for
said, for
liquid
example,
staking.
you take those yield bearing assets and move them between chains.
Yeah. So, and we have two type of liquid staking assets. We have the reward bearing token, and we have a reward earning token, which is a rebase token. So the rebase token, its price is always 1-to-1, but you receive every day a bit of liquid staking tokens on your wallet that simulates the staking rewards. That one specifically is very difficult to rely on an external bridge because they usually don't support rebase tokens. So we created our bridge to also be able to like support our own rebase tokens. So if you natively, actually on Matic, for example, natively you need to stake on Ethereum. It's not on Polygon. So that makes it a bit difficult to enable Polygon liquid staking on Polygon because natively it happens on Ethereum actually. So initially that's how we started to think about that problematic and necessity to also make that a multi-chain experience. And while we solved that problem in a, let's say, in a scalable way, because unlike Lido, for example, we create ourselves on our liquid staking solutions, and every solution is kind of unique because it has every chain have their own specificities. So in the case of Lido, they usually have different teams to work on every liquid staking solution, whereas with us, we do everything in-house, and we always think about how we can scale that to other chains. So the bridge was also a way for us to make that multi-chain liquid staking experience more scalable, rather than using, for example, there is a cross-chain messaging system between Ethereum and Polygon. So you can enable that kind of experience just using the services that Polygon offer you, but then it doesn't allow you really to scale to other chains. So, you know, that's basically one of the differences that we have with our competitors is that, yeah, we try to scale basically what we're doing across different chains. And now we feel like that we support a decent amount of different chains so that we can reuse kind of some modules of everything that we've built. And we hope that in the future, we can actually support other chains much faster than, you know, in the beginning.
Very nice. And I definitely want to get into what applications you see for liquid staking tokens in DeFi in a minute. But first, I think it would be helpful for people if we talked a bit about the dual token model that Ankr is using as far as the B and C assets. I'm going to share my screen real quickly just so people can see what I'm talking about. So I see, for example, you have the AETH-B and AETH-C, and likewise for some other things. Can you share exactly what the difference between those two assets is?
So the B token is a rebase token. So its price is always 1-to-1. So its redemption price, it will be always 1-to-1 because you're receiving liquid staking tokens in your wallet through rebase to simulate the staking reward distribution. AETH-C, so it's a reward bearing token. So that one has a redemption price, or as you see, the fair value, it grows over time. So it started at 1-to-1 the very first day, and then it grows over time. So basically, if you want to get your staking rewards, like you will have to kind of, you know, unstake so that you're getting more ETH than initially what you deposited. Obviously, when you stake as well, you will have to stake in line with that ratio, not to dilute the existing stakers, right? So that's basically that ratio that is quite important. So you can see it as like the redemption price, and that redemption price is then growing over time.
So is this like, for people who might be familiar with Olympus, would this be like Geom versus Ohm?
I'm not sure about that, but yeah, but basically I will say that the main benefits and drawbacks of both versions is that AETH makes it more convenient to understand that the price is 1-to-1. So you don't need to come to Ankr to understand what is the fair price of that liquid staking token. However, most platforms do not support rebase tokens just because they're not very popular, and you need to create some specific things to make it acceptable. So in terms of DEXs, there is so far only Curve and related forks that support rebase tokens right now. And for AC, it's a reward-bearing token, so most platforms support it. So integration into DeFi is much easier with the C token. To make sure, since both have like benefits and drawbacks, we created also Ankr Switch. So it's a little bit like funds. They have different share classes, and you can basically switch between share classes without having to redeem your fund units, wait a few days, and then get a new one, which usually has like a tax event in traditional finance. So the concept of the switch is like you can just switch to the other version at redemption price without having to unstake and stake again. So this is also good for people that want to exploit arbitrage opportunities. And I think for BNB, liquid staking is actually a good example where ABNBB is listed on Ellipsis, and it has lower slippage, it has lower trading fees, and the peg theoretically should be easier to maintain with that version because it's listed on Ellipsis. However, on PancakeSwap, there is still some trading volume, and it's a bit more popular DEX. And with AB and BC, you have then the possibility to trade on PancakeSwap, and it has higher slippage and higher trading fees as well. So what you could do theoretically is, if you see that the C token is traded at a lower price versus the fair value, then the B token, you can buy ABNBC, switch it on Ankr, get ABNBB, and then you sell on Ellipsis at a higher price. So that's a strategy that is technically like zero risk, because you will only, if you do a trading bot, you will only process that trade if it's profitable. So yeah, that's, for example, what we try to do to basically take advantage of both tokens.
I see. So yeah, so people can arbitrage between different DEXs or arbitrage between the current price and then for tokens besides ETH between the price if they were to unstake it.
Yeah,
and so just to confirm, people can choose whether they're holding the B or C. It's not like they're holding the C and then the B is the staked version.
Yeah, they can choose, and they can change their mind, just switch it, and you don't have to wait the unbundling period if you change your mind.
Great. And then so just because some people might be noticing this, right now it looks like some of these tokens are trading at a discount. Is that related to concerns around when the merge is happening, or why do you figure that is?
Yeah, that's a good question. So for example, for the case of STETH, it's been traded at the discount recently, so it was kind of a surprise. But in our case, since we never really incentivize very heavily liquidity pools, because that dilutes our token, and Ankr is like more than liquid staking, we do other stuff. So we cannot just dilute Ankr token just for one product line. So basically with Lido, I think people had the illusion that liquid staking is kind of something similar to a stablecoin, and I think nobody really tried to sell it as a stablecoin. But the thing that the fact that it was kind of market maked and it has really a lot of liquidity on Curve, it really made people kind of forget that it's not a redeemable token. So ultimately, the only liquidity you can rely on is on a DEX, and at some points, if there is too much selling pressure, it will start to trade at a discount. In our case, it has been trading at a discount for a few months already, and we believe that it's a nice liquidity premium. So we don't really see the added value, to be honest, to kind of add farming rewards to convince people to put more liquidity. And by putting more liquidity, the discounts might eventually decrease, when actually you just need to be patient enough to wait for the merge, and then you can just unstake and the discount will disappear, very quickly. because the supply of liquid staking will reduce to basically close that gap. People will earn the difference, and that's it. And then this is what we've been experimenting in other chains. When you have a redeemable liquid staking token, you will see that we don't specially have like insane farming rewards for DEXs, to be honest, on other chains, but it's not trading at a deep discount, because whenever there is a discount, it gives a trading opportunity for people that are patient enough to wait for the unbundling period to lock in that gain.
I like that phrase you used of illiquidity premium. I think that really solidifies what's going on with this.
That's what happens with most of the chains, right? Imagine like on Avalanche, okay, there is many people that, okay, they like Avalanche, they stake, there is a certain staking rewards. Obviously, if more people stake, the yield is going to go down. If less people stake, the yield is going to increase. But in the case of Ethereum, because it is in transition and the merge didn't happen, people cannot really unstake. So the illiquidity of it, actually, if you take, for example, the STETH discount, I'm not sure at how much it is right now, but if you take the discount plus the staking rewards, you could see it as like the yield to redemption. Like in finance, you have the yield to maturity, yield to call. So it's basically a metric that estimates at how much you bought at the discount, potentially a bond, and then you have a coupon. And the yield basically annualizes what you earn until maturity. In our case, there is no maturity, but there is a redemption. So if you assume that the redemption will kind of happen in 1 year, the discount plus the yield can give you a yield to redemption. And that yield to redemption, if people had the ability to unstake ETH, that will potentially reflect how much will be the staking rewards right now. But now people got stuck into Ethereum, they cannot unstake. So, the only way the market can reflect that kind of step back, that people want to stake less and they feel like they need to earn a higher yield for staking ETH, well, it can only be reflected in that way by selling the liquid staking tokens.
That makes a lot of sense. I think something people who are watching need to realize is that there's a lot of players who might be forced sellers because they need liquidity, like you were saying, and that the only way they could get liquidity is by selling these
Exactly.
stake tokens.
For ETH, at least, it is the case, yeah.
Yeah, exactly. And one thing that I think we touched on before the interview that would be interesting to talk about is the potential of staking tokens and liquid staking tokens as a new form of yield-bearing asset. Where do you see those fitting into DeFi and traditional finance in the future?
Yeah, that's a good question. So I think like in DeFi, there is usually, I think, 3 to 4 like main layers of fees that you can fundamentally have. You have lending interest into what I call peer-to-peer lending, like on Aave, Compound, Venus, and so on. You have liquidity mining, where you get the trading fees for providing liquidity on a DEX. There is, well, originally delegate staking, but it doesn't allow you for DeFi composability. So liquid staking allows you to benefit from DeFi composability from that stream of yield. And now recently you have also these routers like Stargate, where you deposit liquidity there and then you get basically the routing fees as well. So it's also kind of a new type of fees that you can have. But the thing is, like, what is the biggest crypto yield market? It's staking. So, I mean, proof of stake staking, right? If you check on stakingrewards.com, for instance, and you see like the billions of dollars that are actually staked on Avalanche, on Ethereum, Solana, and so on and so forth, you will realize very quickly that the biggest crypto yield market is actually staking, and most of it is not even on-chain, because not everyone is using liquid staking, right? Because of smart contract risk or other concerns. So yeah, here you can see really that it is a huge market, And in some cases, like the amount staked is even bigger than the market cap, like in the case of Solana, as you can see, right? 75% staking ratio. It means that you have 75% of all Solana that are actually staked, and you have only 25% that are like in free circulation to fuel all DeFi activity on Solana, right? So there is actually, there is actually also some correlation, I think, between like the staking ratio of like Ethereum, for example, is very low. Why? Well, because it has a higher illiquidity risk. You cannot unstake for now. I personally believe that the perception of liquidity risk to stake Ethereum will be lower at, let's say, a few months after the merge, so that people kind of digest, because some people will unstake finally, and some new people will stake eventually. So when that normalizes, I believe that, like right now, people are happy with 4% rewards, right? But in the future, people will be happy probably with, I don't know, 3%, 2.5%, because it has lower liquidity risk. So what does it mean? Well, it means that, the amount of staked tokens will have to increase to reflect, that lower APR. So the staking ratio is going up, and there will be less freely available Ethereum in circulation. And so that you don't let the market kind of overheat. Liquid staking is actually very beneficial because it allows you to then reuse the value of your staked tokens, borrow against them, or do whatever you want to do with it. So it provides you more financial flexibility. But the main point here is really that the biggest crypto yield market is actually staking, right? So then now, making the analogy with traditional finance, if you compare like stocks, like equities, and fixed income is actually a huge part of traditional finance as well, right? I will say that the main difference is that bonds are like debt securities. Liquid staking is not a debt security because the whole system is not really based on debt, right? We don't need to borrow from a central bank to enable that yield. In our case, for liquid staking and for staking in general, ultimately, like BNB chain, I think it's a good example where the gas fees collected from the chain are collected by the validators, and then delegate stakers can indirectly benefit from it. So it really depends on like the money velocity. I remember 8 months ago, BNB still offered like a 25% staking rewards just because it had an insane amount of transactions, right? And right now it's about 5% because there is much less transactions. So money velocity is also kind of a similar indicator maybe than the GDP. It reflects the economic activity, on that chain. So when it drops, the staking rewards drop. And in our real economy, it kind of works in a similar way, where when economic activity drops, we want to decrease interest rates so that people spend the money and they don't like deposit in the bank, they don't stake, right? However, when the economy is booming, well, then you don't want them to speculate so much. You want them to keep their money still. Maybe you want to save, like now it's overheating too much. So that's why the staking rewards are also increasing. So I personally think that it's really fascinating, that alternative system to enable yield, which is truly different than fixed income, but I personally believe it can be, let's say, as relevant. Liquid staking can be as relevant for, let's say, DeFi, that then fixed income can be relevant for traditional finance in terms of
Wow. And
size.
what you said about it monetizing the velocity of money on the chain, I think that is such a great way to put it, especially for people who come from traditional finance who are trying to wrap their head around where the yield comes from.
Yeah, true. I mean, most of the chains right now are subsidized, right? But I think BNB chain is really showing that, yeah, if it comes directly from the gas fees, so this is really a great way, even for Ethereum to some extent, they're issuing tokens to providing blocks subsidy, and then they're burning the gas fees. In the end of the day, it's a little bit similar, right? But I think fundamentally, yeah, the staking rewards, they need to reflect the money velocity on that chain.
Very, very interesting, fascinating stuff, really. One thing I want to make sure we hit on while we have you on the show is that Ankr is actually much more than liquid staking, right? You guys are also a Web3 infrastructure company. Can you share a bit about what you're doing as far as that?
Yeah, sure. So yeah, liquid staking is kind of the evolution of providing validation services. So initially, Ankr was providing node services. So we could help developers to deploy full nodes and validator nodes. And then basically the evolution of a validator node for us, it was liquid staking, because offering just validation services is a bit like a commoditized business, the same as full nodes. So then the full nodes, they evolved into a blockchain API. However, we realized when we were then offering a blockchain API is we were kind of centralizing decentralized information. And we thought we'd actually found out that tool on Phantom was a Phantom Tools. And it was basically like a network of nodes that was managed with the load balancer. And we thought, well, that's great. It's actually kind of decentralizing the RPC nodes. That's great. So actually, we bought that tool, and we then included the founder in our team, and we decided to reuse the same concept for other chains, and also including some well, tokenomics into it. And basically, our main business now is basically to offer that network of RPC nodes on more than 15 chains, and using Ankr as a pay-as-you-go system. So usually when you consume blockchain APIs from the main providers, you have like a subscription plan, and yeah, basically you overconsume because you need to basically it's not a pay-as-you-go model, so you always need to have more capacity in case there is a peak of traffic in your platform. You need to have access to enough RPC calls. So we thought that basically decentralizing that market and making it an open market, so allowing node providers to monetize their excess capacity from their infrastructure, and at the same time allowing node consumers to consume as a pay-as-you-go model the nodes, it will be really beneficial. And on top of that, it also offers lower latency, because the wider is the network, the more likely, if you are in a remote location, that we have a node like in South Africa, Australia, or Latin America, and then that will offer you ultimately lower latency. So you need to have a very big scale to have different nodes in like plenty of locations in the globe, which ultimately reflects the end users that you have in your platform. If you're a consumer of RPC nodes, that's very likely. So yeah, that's the second product. Then we rebuilt our API on top of our decentralized RPC nodes. So we have an enhanced API. We also experimented with gaming, because we saw it as a great source of like RPC call consumption games. So we built our gaming SDK as a result of that, let's say, experiment into gaming. We also offer app chains. So it can be, so app chains, it's basically side chains on BNB chain. On Polygon calls it Polygon Hedge. Avalanche calls it subnets. So we offer services to basically offer anyone to also create their own sidechain. And here it has really a lot of benefits, where you can have a token that is a native currency of your own sidechain. You have your own validators. You capture, as we said before, like the money velocity into staking rewards, of your own sidechain as well. Yeah, and basically it gives you control on your own chain, right? So if you are, so the first one experiment that we had, it was with MetaHapes, for example. It was a game, but we're definitely looking into other use cases, and also looking into permission sidechains as well. So in the pipeline, we have other interesting stuff to basically enable permission sidechains, because we don't feel like we have the full offering for permission sidechains. Permissionless sidechains, we do have the full offering now, but for permission sidechains, you need to have ideally some zero knowledge proof KYC. You need to offer like a privacy layer, and yeah, there is a few things that we would like to offer on top of that to enable that kind of experience.
I see. And then for people watching, what does it mean when you say something is, for example, a BNB sidechain? Does that mean that it's using the same nodes that the BNB chain is using? It doesn't mean that it settles on it for the audience.
Yeah, so basically it means that yeah, when you do your app on the domain chain, you're going to put pressure on the infrastructure of BNB chain. So if you put it on the side chain, basically the validation process and of the transactions happening on the side chains are up to the validators of that side chain, and then the settlement will eventually happen on the main chain. But that really removes a lot of pressure from the main chain. So if you would like to see a lot of games, for example, that will be very difficult actually to achieve in an infrastructure point of view, because you will need to scale a lot on the main chain, and BNB chain has been having some issues in terms of scalability during the bull market, because so many users were in there. And to scale, the easiest way to scale is just actually to have those side chains. For example, we did a few other stuff for BNB chain, like the Aragon upgrade, for instance, where we participated heavily. But yeah, basically to solve those scalability issues is sidechains is a very effective way to achieve that. And this, at the same time, it can also attract other type of users that want to like experience permission DeFi, for example. So, I personally think that permission DeFi doesn't really make sense on a permissionless chain. You rather have a permission chain or side chain. And then once you get into the permission side chain, it's like open bar, you can access everywhere. You don't need to check, like you don't need to show your ID all the time, right? You just show your ID when you enter that space where you have, let's say, plenty of bars. And once you're in there, you don't need to show your ID every time when you get in a bar, for example, right? So it gives a more convenient experience, I think, in that regard. But there is, still a few things that we need to enable before we go there.
Interesting. And for people who are watching this and their heads are exploding because they're decentralization maximalists, one thing I always like to think about is that intra-app decentralization is different than inter-app decentralization. So it's possible to still have a decentralized ecosystem with individual apps or side chains being permissioned and centralized, as long as they have that sort of main net that they can connect to in a decentralized manner.
Yeah, exactly. So, I think it's also similar with, DeFi, CeFi, permissionless. I think there is like no necessity to see it as like very different things, because you can actually benefit, from both. It's like CDeFi, right? Why not bringing DeFi products into CeFi and allow CeFi to reduce their operational costs while giving an experience to users similar to CeFi? I mean, we saw that with Celsius, right? The fact of using STETH and liquid staking for ETH deposits on Celsius, it's kind of a CDeFi, right, type of experience as well, right? Like Celsius was not doing liquid staking themselves, right? They were relying on other partners and ultimately in DeFi products. And I think it's the same with, permission chains and permissionless chains. I think permission side chains built around public blockchains is something that is very likely going to happen, and we do see some interest from partners currently related to that. So I think it's a very valid offering and a bit alternative to the so-called hybrid chains, that are trying to position themselves, a little bit in between.
That makes sense. And I imagine for compliance reasons and things like concerns around sanctions, that would be an absolute necessity for a lot of players. As far as, go ahead.
Yeah, that might be a necessity, but I think it's also like a chain. Ultimately, it's like a financial infrastructure, right? So I think it really allows to also process things in a much more efficient way. And if you're a very big company, like, you know, like a credit card provider, and you have like plenty of partners, and you need all your partners to offer, you know, to be KYC'd and so on and so forth, having your own sidechain could be also like a very interesting way to like offer like a crypto offering. And basically you force all your suppliers and partners to be on your sidechain to be in line with your KYC requirements. So everyone that is in your own sidechain that is KYC'd, it follows your rules. So, you know, that can be also an effective way to reduce operational costs related to that.
Awesome. And sort of pivoting a little, Ankr has a token. Is that right?
Yes.
Great. And how does the token accrue value from all these things we've talked about today?
Yeah, so currently, like fundamentally, most of the things that we're doing are going to consume RPC calls, right? Consuming from RPC node network creates RPC calls. Consuming from our enhanced API consumes RPC calls. Having blockchain APIs like competitors or partners that decide to, let's say, outsource part of their nodes to our network. So API calls from these partners also consume RPC calls, the gaming SDK, and if you then use the Ankr RPC nodes, it consumes RPC calls. The same for the sidechains, right? If we then offer RPC nodes in it, it will consume API calls. So basically, yeah, the main utility of the Ankr token is really to yeah, it's basically in that pay-as-you-go model, is that the Ankr token is at the center of it. So you will be able to basically pay your RPC calls into Ankr token. And as a node provider, you can also monetize your infrastructure with Ankr tokens. So if you're a partner that are consuming from the network to enable your own API calls, and at the same time, you provide nodes to the network, so you get paid in Ankr and you consume in Ankr. But fundamentally, like, I think the value of it is really like, we personally believe that there will be really a huge increase in terms of RPC calls, right? So really to consume information from the blockchain, right? The validation process happens with the validator nodes. The RPC calls is really just to get information from the blockchain, right? Fundamentally. So the more Web2 companies and Web3 companies want to get access to information from the blockchain, the more RPC calls you're making. So that also means that if you're consuming from a decentralized node network and you need to pay in Ankr, well, then the money velocity of Ankr is also increasing. And ultimately, it is a little bit like being a layer 0, where what is below public blockchains, like the layer below, is really all about the nodes fundamentally, right? So being able to offer those infrastructure services below all the layer ones is really a very appealing position to be in. And we believe that like the network effect adoption of consuming blockchain data from different chains is ultimately going to increase the RPC calls for us, which is going to increase the token velocity of Ankr and make it very appealing. At the same time, we understand that some people might want to pay with other means of payments. So we're also looking into it, like to basically fund your account with you know, US dollar stable coins, or even with credit card and so on. And then it just gets you know, settled in Ankr token. So the node provider is still then receiving Ankr token, and you just charge like a premium on it. It's yeah, it's a little bit similar to you know, what kind of Gazprom Bank has been doing with the gas, you know, and they want it to be settled in rubles, and then they're like, yeah, you can pay in euros, but we're just going to make the conversion and take some premium. Yeah, so it's ultimately you know, a little bit this similar dynamic in terms of like economics, right? And yeah, basically the value of the currency.
Makes total sense. I like that analogy you made. Final question, and I guess this might be a bit lighter. I really was interested in your journey as far as how you started producing content and transition that to working for Ankr. What advice would you have for people watching who want to make that transition to working full-time in crypto or DeFi?
I think, yeah, my main advice is really so focus on learning about, the space, be like engaged with protocols. I think really there is wonderful opportunities to engage with like governance forums, on Discord. Focus like DeFi is very broad, so really focus on, let's say, a segment, that you have a very high affinity and passion about. If you're passionate about lending, really, participate with governance forum discussions with them. And, if you're making like smart comments, people will notice you. So like your contribution doesn't get unnoticed, even though you don't necessarily receive a lot of likes for your content or whatever. But I think this is, yeah, my main advice is really during your educational process, really engage with people. So it can be in the like crypto conferences, it can be, in Telegram and Discord, in governance forums, in questions during AMAs. Yeah, people will notice you, and then you will basically, very likely, increase your network and get opportunities to work in Web3 if this is your goal.
Amazing. And for people who want to follow you, what's the best place?
I will say it's yeah, my Twitter account.
Mm-hmm. And what is your Twitter username?
It's Philippe. So my first name, DeFi.
Filipe DeFi.
Yes.
Perfect. Great. Well, thank you for coming on the show. It has
Thank you.
been a pleasure talking to you, and I definitely learned a lot myself, and I hope that viewers do as well.
Yeah, sure. It was my pleasure. Thank you for welcoming me here.
Thank you, Filipe.